Welcome, everybody. Please do let us know where you're from. You can use the chat function. Today, we also have the reactions available. So if you do like something, please hit the clap button or the thumbs up, and be active and participate in the chat function. But if you have any specific questions for the audience, for the panelists today, please do put those questions into the Q&A. So welcome, everybody. We're just waiting for everyone to come on board, and then I'm actually going to hand over to Peadar Duffy, who is the chair of our technical committee. Thank you, Peadar. Over to you.
Thank you, Carolyn. We're just on the top of the hour. I see the numbers climbing dramatically at 600 odd just now. So I'm going to give people another minute. So just bear with us now, everybody. Keep giving us those thumbs up and telling us where you're from, and preparing also any questions you would like to have to share with our three rock stars, our three sustainability rock stars, Carol, Veronica, and Christian. Right, we're 1 minute past the hour. We're at 748 people and climbing just now. I'd like to say good morning, good afternoon, and good evening to you all, wherever you are in the world. I'd like to invite you all to this inaugural ESG Tech Talk event. This is the first of monthly ESG Tech Talk events. Every second Thursday of every month, you will have an event of the quality and richness of the event that we've planned for you here today. This event is co-promoted with GRI, the world's largest voluntary standards body, and kindly sponsored by Archer Integrated Risk Management. Before I get into the details of the topics and formally introducing our panel and so forth, I'd like to ask Carolyn to share her screen, and because I want to explain to you all what is the ESG Exchange, where we've come from, and so forth, because I'm conscious that many of you are probably coming from the GRI landscape and might not be very familiar with the ESG Exchange. So here you have Professor Mervyn King, who really needs no introduction, as the 800-pounder on the world stage that really would have caused the ripples that would have precipitated events like the creation of ISBE and so forth. If I move down the page and you look at the language there under our purpose, vision, and our impact objective, our problem statement that we're seeking to address is that there just aren't enough experts in the world. That being the problem statement, our purpose is through the creation of a knowledge exchange, to introduce the scarce knowledge that exists in the world, bring it to bear, make it available to large organizations of all types and sizes across the world. Our vision is for people to be using the same language, the same thinking, such that they can move the sustainability dials in their organizations, not for reporting's sake, but to improve the quality of thinking, sustainability thinking, and so forth. And our impact statement is 10 million people from 10,000 global organizations who have been brought through our sustainability fundamentals, our how-to playbooks between now and 2030. We have two missions. The first mission is to convene the global reporting ecosystem, described with these two diagrams here. The diagram on the left largely reflects the logic, the standard setters in the center, working out through the commercial organizations on the outside. No surprise, on the diagram on the right, you'll see TCFD, the North Star to the three global regs, FRAG, the CSRD rather, ISBE for the rest of the world, and SEC for the States. Our second mission is then to convene the global experts, get a consensus as to what good looks like, because it's all very fine for standard setters to write standards, but how do you operationalize? How do you do the doing? Again, not just for shallow reporting's sake, but to improve the quality of discussion, the quality of thinking, and getting that sustainability dial to move from, let's say, fossil fuel economy through to green economy and so forth. And at the bottom of the screen, then you will see our governance structure. which will change over the next quarter or so. We can now move back to the panel, Carolyn. Thank you. We are organized in the context of 3 sets of questions we're going to ask of each of our panelists. Effectively, the first question will be, what matters most in the context of materiality through the lens of GRI, ISB, and the corporate, Christian Hellier from the VBA as the proxy for the corporate organization. But first of all, in terms of introductions, and we will also be holding, at the end of each round of answers provided to questions, we will have a poll, 3 poll questions. So, introducing our panelists. Carol is a chartered accountant and a professor of accounting at the Durham University Business School. Carol is chair of the GRI's Global Sustainability Standards Board. Her research is concerned with the role of accounting and reporting in the relationships between business, society, and the environment. She has led the development of sustainability reports and advised on sustainability and integrated reporting to major organizations. Recent policy work has included advising the UNDP on its SDG impact standards. Carol has sought to advance practice and policy with respect to integrating sustainability considerations into organizations and educating the next generation of business leaders. Veronica is a vice chair of the Deloitte UK organization and global IFRS and corporate reporting leader. She leads Deloitte's contributions to the World Economic Forum, International Business Stakeholder Capitalism Metrics project, including the World Economic Forum's recommendations to ISB, the International Sustainability Standards Board, and she helped launch the UK Directors Climate Forum Chapter 0. Veronica's external appointments include membership of the IFRS Integrated Reporting and Connectivity Council, and she's a member of the G7 Impact Task Force. Christian is vice president at BASF and is seconded from BASF as CEO to the Value Balancing Alliance. The Alliance focuses on the development and standardization of an impact accounting methodology, including testing in day-to-day business. More than 25 international companies are members of the Alliance, contributing to its success by providing know-how, workforce, and budget. The EU Commission has mandated the Alliance to provide natural capital accounting principles, which is reflected in the CSRD. The World Bank, the OECD, and the EU are policy advisors to the Alliance. With that, I will now frame the first question, the topic being, of course, impact, rather materiality from impacts to risks and opportunities. Carol, as chair of the GSSB, what matters most? Carol, you're on mute.
I can't believe I'm still doing that. So what matters most under GRI standards is accountability, sustainable development, and gradually improving your approach to both of those issues. So when we talk about accountability, we're talking about accountability for the organization's impacts on the economies, on society, and on the environment. It requires an understanding of the organizational context and disclosing that context to increase that understanding. It also requires disclosing the organization's processes. So these might be the management approach to material topics. So how are those topics managed? The governance oversight of all of that, how impacts are incorporated into strategy, policies, and practice, and the approach to stakeholder engagement. So we're looking for accountability for all those things. And many of those disclosures, particularly around management approach, engaging with stakeholders, governance oversight, really help the organization move towards making a positive contribution to sustainable development. They change thinking within the organization. Now, the reporting has to be credible, so we are really keen to see assurance of sustainability reports under GRI standards, and see the scope of assurance increase. So at the moment, there's about 39% of GRI reports, according to IFAC, have external assurance. That's considerably more than any other standard or guideline. And, you know, we want to see that grow, and very happy with the work that the International Auditing and Assurance Standards Board and the International Ethics Standards Board are doing in terms of developing standards that are profession agnostic and standards neutral in that regard. So that's, I guess, what really matters under GRI standards. That's what we're trying to do, give organizations a way of being accountable and move in the direction of sustainable development, and help the users of those standards make decisions which also move in that direction.
My turn to put on my my mute button, to unmute rather. Veronica, from your perspective, from the ISB perspective, what matters most?
So yes, let us maybe go back to the what we have said about the topic of today's discussion, which is materiality. So from the ISSB's point of view, the concept of materiality, of course, and I guess in the more common language, we would say, is there to determine, you know, what is important to a person, what influences their decisions. So when I start talking about the IASB, so financial reporting, and the ISSB, the reporting on sustainability factors, the financial disclosure of those, the primary user is defined as the existing and potential investors. So we're looking at lenders, we're looking at creditors, so we're looking at providers of capital. So the critical point, therefore, is when you're starting to go from an ISSB perspective to consider what is material, you're considering as to whether information is of such importance that omitting, misstating, or obscuring it, quite an important word, obscuring it, could reasonably be expected to influence the decisions of those primary users. And those are the users of the general purpose financial reports. And they're making decisions on the basis of those reports. I guess all of those elements are quite critical in the definition. So ISSB standards, therefore, when it comes to sustainability matters, get you to think about the factors, the sustainability-related risks and opportunities that could reasonably be expected to affect the entity's prospects over the short, medium, and long term. What can affect its ability to create and sustain value over time? That's the first thing that we are having to observe when it comes to materiality discussion with the ISSB. The second point, which is again very, very important here, is that sustainability-related financial information relates to activities, interactions, relationships, the use of resources throughout the entity's value chain. So entities will need to look at things like their own employment practices, for example, but also those of their suppliers. So they would need to look at things like wastage related to the packaging of the products they sell, or events that could disrupt the supply chain. So they're looking very broadly. So the interesting thing about looking broadly, it also includes looking at their investments, including investments in associates, joint ventures, and the operations they do through those investments, but also investments, for example, in pension assets that support the pension schemes for their employees. And when they're looking at this, and they're looking there to make their judgment of what's important, of what's material, there is a relief, because obviously, you know, that population can be huge. There is a relief. It's not an exhaustive search. There is the consideration of undue cost or effort. So determining what constitutes that undue cost or effort, of course, will be different and will depend on the entity's specific circumstances. And it will require a balanced consideration of the costs and efforts involved versus the benefits to the user of that information. So I think it's important to recognize that when going about identifying all of those issues, entities can go and look at the other frameworks like that of GRI, which, as you could hear from Carol's narration, it is very broad. It gets you to think really broadly about the business's role in society, its contribution to society, how it positions itself within that bigger system. So you look to GRI, you look to SRS in order to start thinking about your interactions with the world. But importantly, of course, you are looking at the interaction of your specific business model with the world, and potentially thinking about that octopus diagrams that we use in the integrated reporting to understand our business model, to understand our value creation process, to understand its touch points with the world. So fundamentally, just to summarize all of that, pragmatic application of that approach can and should lead to what we're looking to achieve here, which is fair, balanced, and understandable reporting to the primary user here, who is investor, provider of capital.
Thank you, Veronica. Christian, here representing the voice of the customer, as CEO of the Value Balancing Alliance, what matters most to the corporate in applying these standards, applying materiality, double materiality, and so forth?
And many other concepts of materiality, as we know, are in the room. So this is one of the, let's say, key questions for corporates. Most of them, and I'm representing really here the forward-looking ones and the leading ones, are slightly confused what's currently going on in the market if you're looking at the new standards coming up. And I think financial materiality as outlined by the IFS Foundation, and let's call it impact or stakeholder materiality as introduced by GRI, are for sure the foundations to look at this. And we now see with the ESRS standards that there's a new notion coming in with the word of double materiality, with new processes where the corporates are now trying to understand how should I apply now the next standard coming up and the next regulation, and how do I make this, as Veronica said, as pragmatic as possible. And how do I generate out of this process really meaningful information for me as a business when we are talking about really decision making? Because materiality in the end sets certain cornerstones for the corporates where to move in the future. But also secondly, what kind of information do I need to deliver or disclose to the external stakeholders? And here at the forefront, if you're stock listed, yes, the investor. So here we're really talking about financial materiality, but also other stakeholders. So the society, but also silent stakeholders like nature. And I think one of the key the key questions which corporates are currently asking themselves is, if I understand my impact materiality across the value chain, how does this hit in the long run or in the short run my financial bottom line? And this is something where the work of organizations like TCFD, TNFD upcoming, but now also the work from the ISSB and the collaboration with GRI is of utmost importance, because this is really what counts in the end, as long as we're still working in the global market economy.
Thank you, Christian. So I'm going to ask Carolyn now to launch our first poll question. And when you're answering the question, I'd ask people to consider, based on what you've heard just now from our three experts, what questions would you like to put to our panel? Because I really do want to give 10, 15 minutes towards the end for answering questions and so forth. So as you're answering your poll questions, I now want to ask the second round of questions to our panelists here, again, starting with Carol, in the context of challenges. What are the biggest single challenges that you see in the context of the question of materiality, from impacts to risks and opportunities? Carol.
Yeah, thank you for that question. And I do hope that after I've answered it, more people will think yes to your poll question. Carolyn, could you share that diagram from GRI 3, please, on the process of determining material issues? What this diagram does is set out the process of determining materiality under the GRI standards. And I want to then go on to explain how you get from that to identifying, the risks and opportunities. So the first step here is to understand the context of the organization. And you can use the sector standards for that. It's about understanding the activities of the organization, the business relationships, and the stakeholders of the organization and what they're concerned about. The second step, step 2, is about identifying the actual and potential impacts of the organization. And you can use the topics in the sector standards for that process. And the third step is assessing the significance of those impacts, whether that be positive or negative. And throughout that, it's about engaging with stakeholders, talking to experts, NGOs, academics, lawyers, consultants, and so on. So through that whole process of engaging with stakeholders, you're actually finding out a lot about what matters to them. And this includes investors. So GRI is a multi-stakeholder organization. Through all our standards development processes, we involve a range of stakeholders: civil society, investors, businesses, what we call mediating institutions, and labor as well. And the next step would be to prioritize those impacts for reporting. And what we believe at GRI is that the impacts of an organization's on stakeholders and the cumulative impacts of a number of organizations, for example, on pollution into a particular river, for example, does impact the availability of resources to the organization, and the risks and opportunities for that organization, which then have financial effects for the organization. So, we know that GRI reporters who also do integrated reports, for example, have done a better job at identifying the risks and opportunities to the organization, because they've extended that process of determining material impacts, recognizing that then has implications for the capitals feeding back into the business model. So really what we're saying is that to ensure you identify all your risks and opportunities arising from your impacts, you need to go through the GRI steps. And this is what the ESRS and the application requirements to the ESRS also say. So they come from GRI 3. Now, we've been discussing at the GSSB a revised box 1 for GRI 1, explaining the relationship between the GRI standards and the IFRS S and ESRS standards. And this is a paper that's going to tonight's GSSB. I think Carolyn has a link to that paper that she can share, and also a link to where you can watch the live stream of our meeting in a couple of hours' time. I shouldn't say tonight because you're all in different parts of the world. So I think those links Carolyn can share. So what we think at the GSSB is that most, if not all, of the impacts for GRI reporting lead to risks and opportunities for the organization, and in the long term have financial effects. We don't believe that it's only a subset of these impacts that are relevant to investors. So investors are a key user of GRI reports amongst a range of other users, and we discussed this at our April meeting. So we believe this full set of impacts is relevant. Now, organizations can start at any point, though. So we get the accountability by asking organizations to fill out a template, a content index. And when they're not able to report a particular issue, even if it's just because they don't have the data yet, they can just state that. but the accountability is there in that, you know, they've gone through this process. They've said they're not reporting that particular impact for whatever the reason is, and an investor or other user of the reports can see that. So a couple of examples that we give in box 1 is that if you're using non-renewable energy, that has an impact on climate change, and over time it will increase the costs to the organization as non-renewable energy costs increase. And also an organization might have a track record on human rights and equal opportunities. That is attractive to skilled labor for the organization. It enables the organization to produce better products, deliver better services, improves its reputation, and that also has an implication on revenue for the organization, of course. So we believe that all material impacts on stakeholders do in the over time, you know, are relevant to investors. So that's the link from GRI to reporting on risks and opportunities.
Thank you, Carol. So Veronica, I'm going to skew this slightly differently in the context of ISBE and so forth, and ask you, what are the challenges in your view of applying existing investor-focused materiality concepts to sustainability issues?
Yeah, thanks, Peter. I think the key challenges in applying what we often call financial materiality, though of course it isn't really financial per se, because that word is not even used in the definition of materiality that is focused on what is that company needs to report to its provider of capital. We call it investor-focused materiality. So let me talk about investor-focused materiality. So what's difficult? I think it's the fact that we're looking at a much broader population of issues, and we need to consider how they play out over time. So Carol's point about the fact that so many of these issues become relevant over time to investor is one of the key challenges. The other big challenge is that in order to understand those risks and opportunities that I need to report in the world of sustainability, I actually need to understand where they arise from. So I need to think again holistically my business model, and I need to think the value chain. So where do those risks arise across my entire value chain? So let me just again emphasize that many sustainability matters actually play out over longer time horizons and may only translate into financial outcomes at a much later time. So, for example, and again, consistent with Carol's example, if I go to the changing weather patterns as a result of climate change, that will affect the business and it will affect society. It'll affect businesses' ability to do business. Ultimately, I think we already talked about the fact that we need to look at the matters that sit outside, if you wish, the direct ownership and control of the company. And that is looking to activities, looking to resources, looking to relationships that a company uses and relies on to create its products or services. And we're looking from conception to delivery, from looking at consumption, looking at the end of life. We're looking at financing, we're looking at geographical, geopolitical, regulatory environments that the company operates in. How is that all going to affect its ability to sell its product to services? How does it affect its ability to actually make those products in the first instance? So we're looking really broad, and that's where lies the challenge. The other part of that challenge is the fact that a lot of these factors are qualitative in nature. So not easy to put a specific number on anything. And they don't necessarily translate into a direct cost or a balance sheet item. But nonetheless, they do represent drivers of risk and opportunity. They often affect what we refer to as unrecognized intangibles, like company's brand or reputation, or it's effectively licensed to operate. And they're really essential to an understanding of the value of the company. So when we are thinking about the business model and materiality, we also need to recognize that, you know, value created over time, but it is inextricably linked to the value created for its stakeholders. So if I take stakeholders in a broader sense, that includes the environment and the society, the communities, the everything around us, the people, planet, prosperity. So we do need to understand that my ability as a business to create value is actually inextricably linked to the value created to those broader stakeholders. And so that consideration of impacts on economies, the environment, the people that Carol was talking about absolutely can affect a company's performance and prospects, but critically over time. So, and we give lots of examples. We can think about lots of examples here. We can think about health and safety, for example, you know, within direct operations or across the supply chain would be extremely important because it affects the ability to recruit staff, therefore my ability to actually operate. You know, in terms of that, of course, that also affects my customer sales. If I can't operate, can't produce, I can't sell. And of course, it then directly affects my ability to generate value. Cost of employment goes up. So, you know, this is an example where I can directly relate this, not only to an intangible value, but the specific line items in the financial statements, current or future. The scarce natural resources, the same, the shortage of water. And if I happen to be a beverages company, you know, my use of water in a stressed area, more likely or not is going to be a direct cost in my financial statements at some point, if not now, because frankly, it's going to become more expensive. Taxes, limitations may force me to move into a different location in order to continue to produce and things like that. So again, if I can say that what we're really talking about is understanding, using that octopus model, again, I love the octopus model, as you can hear, using that model to try and understand your inputs, resources, your business process, your impacts and outcomes. That's what you're really looking at. And of course, what I think is also important here to understand is that, you know, in financial reporting, we already do this. We already look broadly. I think we already need to just stop and say, well, nothing here that I described is actually different from the process I do in financial reporting in order to understand the drivers of values, the risks, the opportunities. So the process has to be wide, whether I'm talking sustainability issues or financial risks. Think of the risks today, right? Financial risks or sustainability risks, they all can play out in a dynamic way very rapidly, and they can absolutely affect how my business model can respond to some of these risks and opportunities, how resilient, how sustainable it is. And in fact, you know, many statutory duties of directors and in certainly frameworks like the one we have in the UK already recognize that need to look to long term. They already recognize the duty of the directors to have regard to the stakeholder interest, to have regard to the wider factors that contribute to that long-term success of the company.
Thank you, Veronica. And Veronica, can I just confirm that when you talk about the octopus model, you mean the integrated reporting model, the capitals out?
Yeah, the business model,
Okay.
Business model articulation in the integrated reporting. I know it's described, somebody described it to me as a tarantula or something the other day, which was surprising, but I think we all know the one we're talking about.
What I'll do is just whilst Christian is answering the question I'm going to put to him now, I'll put that visualization in the chat for people just in case they're not familiar. Christian, so not surprisingly, we see a striking alignment in terms of thinking and approach between the GRI, ESRS kind of perspective and the ISB perspective. And that's surprising in the context of the whole drive towards interoperability and all that. But when the corporate is looking at, in particular, for example, the CSRD, the Draft Delegated Act that came out last week, you know, there's a lot of stuff, you know, when a corporate looks at a document and it says, shall do the following things, that causes the corporate look at this differently from the standard setter, let us say. What are the challenges that you see for the corporates ahead?
So I think, first of all, corporates are looking at this whole concept a little bit more from a practitioner's point of view. I think they're not so much differentiating between single materiality, double materiality, dynamic materiality, because this was pointed out several times already. Somehow today or in the future, it hits your financial bottom line anyway. So we're talking about things that really matter, and corporates trying to identify what it really is and how they need to embed this into their own process, but what they also need to disclose to their stakeholders. In specific, what are, let's say, the largest challenges corporates are currently facing? And here I'm building on the comments Carol and Veronica made, and I would differentiate here 3 aspects. The first one is topics or content. The second one is the value chain in the end. And the third one is the scope of the application in general when you're talking about partnerships, joint ventures, whatever. So when we're talking about topics and content, I think, yes, you have mentioned this better, there is some consolidation ongoing, but corporates are still thinking about where is this global baseline, and we are all aware it can't just be climate, which is currently looked at the ISSB, but fully aware that ISSB is going beyond. We have the framework of GRI, we have other frameworks in place, be it the Capitals Coalition with the Capitals protocols and so on and so on. So corporates are really thinking, what is this framework I can build my work on? So narrow down the content focus. The second one is with regards to what is the scope of this application? And here we're talking, Veronica mentioned this value chain, scope 3 in the end, how you get the data in. Yeah. So we're talking about tools, we're talking in the end about data sets, which can also in the end be audited, because in the end, an auditor needs to look at the materiality analysis if it's in line with the standards, yes and no. And this is, I think, one of the major challenges which corporates will face looking into the ESA standards and the E1 now, because it's increasing in the end the process steps compared to what we know and what we have seen from GRI. And here people, or let's say the responsible people in the corporates, are starting to think, how can I apply this and how can I ensure that my auditors are really assuring what I'm doing? Last but not least, and I think here this is also going in the direction of the scope. What kind of partnerships should I get in? You know, what kind of joint ventures? And here more or less linked to the consolidation circles, what we have from financial reporting, how is this interlinked? We see that there might be some differences between ISSB understanding and ESRS understanding. And I think this is stuff we really need to work through. Time will show how we're going to approach this. How do we make this pragmatic? And this is still an area of uncertainty, I think, which is rather clear as we are now running into this whole development and this, let's say, different frameworks in place. So this uncertainty piece is something what considers the corporates most at this point in time.
Thank you, Christian. Carolyn, if you could maybe run the second poll now, which is, do you understand double materiality? And just as people are reflecting on and here's the answer to the first, I think I do. Okay, that's a fairly honest answer. I would have thought the answer to poll 1. We'll refer to the poll results at the end of the Q&A. And Carolyn, have we launched the second poll? Yes, we have. Excellent. But I'm minded that I've got a particular point of view as you're selecting your answers there, that really ESG, and of course ESG is the data, sustainability is the outcome, but really it's just old risk management wine in a new bottle. Yes, you've got different taxonomies, different units of measure. You have to pull it all together, make sense of it, make a decision useful, aggregate it, and all that kind of stuff. But from a fundamentalist perspective, it's just old risk wine in this new bottle. So our last round of questions, and again, Carol, back to you. Now getting into kind of insights and perspectives, more to the point. We've discussed, you know, what's important. We've discussed the challenges. Now, because some insights, how can GRI materiality assessments and disclosures inform decision making from your perspective, from the GRI perspective? You're on mute again, Carol.
So it's the disclosures about the process that the organization is going through, that engagement with stakeholders, the management approach, which allows organizations to improve what they're doing and manage what they're doing. Sorry, what was it you asked me again?
My apologies. Let me just reframe it then.
So put off by the unmute thing.
My apologies. How can GRI materiality assessments and disclosures inform decision making?
Yeah, okay. And so then you go through that GRI materiality assessment process, as I said, to identify risks and opportunities. So you can manage those risks and opportunities. You can manage the impacts, which also is about managing the risks as well. And so that is critical. Now, investors make their own assessment about the risks and opportunities facing an organization from its impact. So they like to see the impacts because, risks are really underreported by organizations. The sort of reporting on risks about social and environmental issues and impacts on the organization is very poor at a very low level. So if an organization is reporting its impacts, it gives investors the information to make that assessment itself. And so, I was mentioning the GRI being GRI reporters doing integrated reporting more completely. They also do it quite differently. They're talking about value created, not just for the organization, but for a range of stakeholders. And that's also important to the organization, that it's creating value for stakeholders. So GRI reporters, and we've seen some really fantastic ones in integrated reports in South Africa in particular, where they talk about value creation to the wide range of stakeholders that they are engaging through their GRI materiality process. And investors also want this information on impacts because they're looking long term. There's a large proportion of the world's investors, pension funds and so on, that are investing for the long term. So this, the impacts, we know, as Veronica said, that some of them don't materialize to affect the organization for quite a number of years. It can be decades. But also there's an increasing proportion of investors that are looking at having a positive impact as well as making a financial return. So this is, this GRI materiality process really is the feed-in to the determination of the risks and opportunities and financial materiality. And the ESRS standards, they also make that clear. Now, the GRI standards are also used by governments who are interested in the impact of organizations. They're interested in the impact of large corporations on the economy. They're interested in where tax is paid by large organizations, for example, and the contribution, positive or negative, that organizations are making towards the sustainable development goals that many national governments have committed to report on at a national level. Employees use this information. We know that a lot of organizations are putting key sustainability data in their annual report, knowing that employees will look at it. These reports are not just, they're read by a range of stakeholders. Employees use it to make decisions about whether to stay, where to go next. Prospective employees tend to look at these reports too. And, big corporations who are customers of a range of suppliers around the world look at what their suppliers are doing, big and small, because that influences the reputation of the buying organization. So we've seen, major issues in the supply chain around labour rights, human rights, for example, which has come back to have a significant impact on the reputation of the buying organisation, and through boycotts had a significant impact on revenue and on the business. So
Thank you.
I'll leave it there.
Thank you, Carol. I'm conscious of time. I really do want to get in the Q&A from folk. Veronica, I'm going to ask you kind of a technically deep kind of question here now. You were part of the group of 5. So from your kind of inside perspective, how could, and maybe you want to explain to people what the group of 5 was, how could the nested and dynamic vision that you set out there help corporates in thinking about the GRI style materiality and the ISB investor focused materiality?
Yeah, thanks, Peter. So, as you say, I was actually privileged to facilitate the work of the group of 5 of the leading sustainability standard setters and framework providers. So who we're talking about here? Well, we're talking about GRI, we're talking about SASB, we're talking about Integrated Reporting Council, which was part of the Value Reporting Foundation. You're talking about CDSB that first did a lot of work on climate and was the predecessor to the great work of the TCFD. You're talking about CDP, as you know, who are, one probably is the largest data collector out there. So we're talking about the work that resulted in a set of recommendations which were taken on board by the Technical Readiness Working Group, which did a lot of pre-work for the launch of the ISSB at COP26. So Technical Readiness Working Group was the one who developed the prototypes of climate standard and the general requirements standard for disclosure of sustainability matters. And that technical work itself was based on the work of the group of 5. But why is this relevant to the conversation? Well, what group of 5 did do, it showed how you can visualize materiality, how you can contextualize that in terms of what it is that you're trying to do. So it showed a picture of the dynamic and nested materiality, where it shows that the outer box is your population of the, in a broader sense, across the value chain, across the long-term time horizons of all the impacts, of all your impacts on all of the stakeholders that your business has a touch point. So it's still entity specific. We're looking at it not from some sort of macro picture. We're looking at it from the point of view of the entity, but what are its impacts? What are the touch points of the business model with the world? So that's the outer box. Nested within it is a middle box, which is the sustainability information that is investor relevant at a point in time. Because remember, reporting happens at a point in time. It is a reflection, it's the analysis at a point in time. So we are not necessarily looking to eternity here. We're looking at the time horizons that are consistent with the business model. I think we are then looking into that to find the subset, yet another subset of the factors that are already playing out in the financial statements. So climate change is a classic example where we can see that first, when we started thinking about climate change all those decades ago, it was something that it was becoming of interest to society, it was becoming of interest to science, it was starting to feature on the radars, but all those decades ago, back in the 1960s, 70s, 80s, we did not view them as directly value relevant. So they would have potentially sat in that outer box. Now, over time, and at a point in time like now, what we do all know is that climate change is directly relevant to an entity's ability to create value over time. So it traveled into that middle box. And how this will manifest in different industries and different entities will be different. The magnitude, the significance, the actual impact on the entity of the climate change will differ. But nonetheless, what we can say for now, for sure, climate change is here and now in value relevant box. And then finally, if we go into the middle box, well, how does that then translate into the financial statements? Well, again, if we take the climate change, well, we're already factoring it into our impairment calculations in the timing of the decommissioning provisions. When are we looking to pay specific payouts under regulatory, tax, or litigation type of cases? All of that will be directly feeding into the financial statements. So what you can see me describing here is what I would say is dynamic nature of materiality. And that's why the diagram is often known as dynamic and nested. And Peter, to your practical question, and I can see lots of practical questions popping up as we are looking at the chart, I think this is exactly what a corporate's mindset should be. That's what, if you wish, we all need to be having in mind when we think as to how do I reconcile this compliance reporting framework with this compliance reporting framework. We're not talking about compliance reporting. We need to start with that point you made, data. We need to start with what's relevant to my business, what data is therefore needing to support my business and strategic decisions, and then decide as to who am I reporting to. That is my primary user group. Therefore, what it is that I should define as the material matters at that point in time.
Yeah, thanks, Veronica. And Christian, from your perspective, you know, in terms of my day job in Archer, you know, I think with a kind of a data mindset. These data, they're available, but they're not readily accessible. And then you have to identify the stuff, you have to cleanse it, you got to structure it, and then make a decision useful so that people can make their kind of, you know, risk and opportunity informed sustainability decisions. So that's quite a different space from the theory to the practical now. How do you operationalize all of this? What are your views?
So I think also here we are on a journey, but maybe as a first one, most of the corporates now working in this field, they just want to get their business right, means they want to be financially successful, and they want to have a resilient business model in place. Yeah? That means they need to have the access to their customer, they need to have access to the financial market, so we need to understand what are risks and opportunities. And a materiality assessment is more or less nothing else than assessing your risks and assessing your opportunities. And the materiality analysis with related processes, I think, is lots of self-reflection what you're doing as a company, if you're on the right track, and it's bringing in the stakeholder perspective, if your own perspective is the right path forward. But to get this really into decision-making processes, I think Veronica pointed out one important aspect. It's about metrics. And currently it's really, really difficult if you're looking into financial indicators, and when the ESG indicators or sustainability indicators, however you might say so, how do you evaluate what is more important? Because you can't compare CO2, tons of CO2 with health and safety incidents and everything else. So the valuation piece needs to kick in to make this really comparable. And this, I think, is then the first step also to link it much closer to financial performance and to understand how it hits in the future your financial bottom line. And then I think, and this is what we see here within the VBA, corporates using these kinds of metrics and trying to value the impacts and dependencies what they have already. They're totally changing in the end their target setting processes. They're changing the incentive schemes what they have in place, based in the end on materiality analysis. And I think this is the key to really understand what is material for your different stakeholders and then to react in the end in all of your management processes. But I think we are still on the journey to find the right tools. We are still in the journey to find the right and most pragmatic path forward. But here, I think all the work what we see from the standard setters is quite helpful to get more guidance.
Thank you, Christian. Carolyn, could we put up maybe our third and last poll and also the results of the second? And as people are, and you got some thumbs up there, Christian, for your answer. So the second question was, do you understand double materiality? Slight changes there in the numbers, which we're going to reflect, and we'll do a short report after this, by the way, and share it with everybody. And so, Carolyn, you've been monitoring the questions coming up in chat. Maybe you could come on to the panel yourself just now, or maybe you could put up some questions that I'd like to put to the to our panelists. And by the way, for people in the group here, you know, we have what, 1.2, 1,200 people on the call, on the webinar. That's quite a good number. Sign up to the newsletter, sign up for access to the how-to playbooks, and keep following us in terms of these monthly ESG Tech Talks. But I guess we're now probably finished the third poll. Carolyn, have you identified any particular questions, or is there a particular type of question that has got most traction so far from what you can see?
Yes, so the one that got the most, 22 votes, is the one from Natasha, and really it's the practicalities of it. Are there any examples of materiality assessments available for guidance? So we do have guidance documents in terms of how to set these up. So GRI has got a guidance document, etc. But I think the question is, practically, do you have any cheat sheets or guiding documentation, a step-by-step guide on this?
As people are thinking about that, can I just say to people that one of the practice groups that we've established in the ESG exchange, for which we have conveners and members and so forth at the moment, is the Materiality practice group. And it will be looking very much exclusively at how do you operationalize doing materiality assessments. So people that have an interest in learning the outputs from that group, sign up to the ESG exchange, and you'll begin to see practical content that can be applied to organizations with effect from Q3 going into Q4. Wow, okay, distinctly different.
Maybe just to say, Peadar, that all of the Q&A questions and answers and the chat, we will have access to. We will be putting them up onto the website as we go through them. And we will be trying to reach out to the panelists as well as others to come up with the answers to these questions. Thanks.
Thank you. Carol, you've unmuted yourself, so I'm going to ask you to have you come across any particular examples of what good looks like to that question that was asked in chat?
Well, yes, there are a lot of good examples of how organizations engage with their stakeholders to identify the issues that are material to those stakeholders, and then how they assess those material impacts. So, I can't think of particular ones off the top of my head. I don't really want to single any out. But if you look at the reports of a large organization, pick a couple in your sector. They use GRI reporting. They will talk about how they're engaging with their stakeholders and how they've identified the material impacts for their stakeholders. They don't yet talk about how they then go from that to looking at the risks and opportunities. But it is about that engagement with the stakeholders and that identification of the material impacts, which informs them how, what the material risks are going to be from those impacts. And so that process of prioritizing the impacts and working out your approach to managing the impacts also sort of brings in thinking about the risks and opportunities that arise.
Thank you. Any other, Veronica? Sorry, I see you there now. Thank you, Veronica. Your thoughts?
Yeah. So I think you probably got a fair number of integrated reporters on this call. And there are quite a few good integrated reporters out there in the world. And may I just say that that is a classic process where you start with the bigger picture and then get to the risk and opportunities understanding using the techniques and the useful tools that integrated reporting puts on the table. Because remember, integrated reporting framework as designed is there to meet the investor needs as the primary user, it says so, but in recognition of the fact that those cannot be met without understanding those broader impacts on broader stakeholders. So it's the model that already reconciles that broader view of life with the investor-focused reporting. And that is why I think we do have some really good examples of how to apply this. Companies do. And we see that at the Finance for the Future Awards, where Accounting for Sustainability has been promoting. This is His Royal Highness Accounting for Sustainability, now His Majesty's Accounting for Sustainability, that has been promoting a lot of good examples of how companies do it.
So we're up on the hour. We really have had a wonderful discussion. Again, I remind people, sign up to the newsletter. If you want to join any of our practice groups, you can just land on our About Us page and you can apply there and so forth. We do have criteria both for membership of the Advisory Council and also for the Technical Committee. But thank you so much for your very kind commentaries there in terms of support for the panel. Each member of the panel here is a member of the ESG Exchange. So if you want more of this, stay connected with the ESG Exchange. Good morning to you all, good afternoon and good night, and thank you all for sharing your precious time. See you on the 13th of July. Thank you all. God bless. Bye-bye.
Thank you, Peadar. Thank you for hosting this on behalf of the ESG Exchange. Thank you for all the work that you're doing for the Technical Committee. Thank you, everyone.
Thank you all. God bless. Bye-bye.